Good morning, everybody. I'm Jeff Callow, the Head of Investor Relations at Ecora Royalties. Happy to spend 10 minutes taking you through our story at a high level. If anybody's got any further questions, then please swing by booth 401 and have a chat, and we can go through things in greater detail. So the first thing I would say, or three things I would say about Ecora to sort of frame the presentation. The first thing is we're a royalty business. We are a royalty business that is focusing on critical minerals. So very different to most of the royalty companies that you will see here today, where the focus is very clearly on precious metals. Secondly, we have a very well-established production base, or set of producing royalties. So on analyst numbers, this year, next year, you'd expect to see us do around $55 to $65 million of income. So we're a pretty well-established business for a company of our size. And the third one is we're very fast growing. So our critical minerals, so we've got that $55 to $65 million platform, but as we go through the presentation, you'll see we have the ability to take that up to over $100 million by the end of the decade on the analyst consensus numbers. So we think we're a very high growth, fast growth business. Looking at the slide here, you can see the composition of our business today. On the top left, I'd say critical minerals is our focus, 82% in base metals, but 50% of that in copper. And we think that's probably the best exposure you can get to copper in a royalty model anywhere on the planet. And that's going to grow and become a very large part of our income over the coming years. Outside of that, our key commodities are cobalt, nickel, uranium, and rare earths. As a royalty company, we don't take a lot of risk jurisdictionally, so you can see on the bottom left there, we tend to focus mostly on OECD and established mining jurisdictions. So 85% of our royalty exposure is to those sort of geographic locations. And as a royalty investor or royalty company, it's very important for us to invest towards the lower end of the cost curve. If they're development projects, they have the best chance of attracting capital. And if they're operating projects, they're better placed to weather commodity price cycles and stay in production. If those mines stay in operation, we get paid. And finally, we've got a really nice balance, I think, now. If you'd looked at this slide 10 years ago, we would have been 90% coal in the top left, and we would have been 80% probably producing in the bottom right. We've really transformed this portfolio from a coal-based portfolio 10 years ago to something which was short-dated and the coal was running out. By redeploying those cash flows, we built a business which has 20 years plus of life in these commodities and these royalties that are coming in, and will see us well for the future. And our operating partners are very well-established mining businesses. So you can see there, for a company of a sort of $500 million market cap today, the operational risk is not that's normally commensurate with such a company. We've got partners including Vale, Capstone Copper, Cameco, names that will all be very familiar to you. NextGen as well, we're very excited to have a royalty over some of the drilling they're doing up in the Patterson Corridor East in the Athabasca there alongside the Arrow discovery. I won't go through this list in detail, but suffice to say this is our royalty portfolio. In the orange, you can see the producing royalties. There are 9 of them today, as I say, and we've got some near-term growth from 2 of them. Voisey's Bay, we have the cobalt stream from that mine. That's ramping up quite aggressively. We received about 200 tons of cobalt in 2024. We're on track to do just over 400 tons in 2025, and that's going up to sort of 500 plus in 2026. And if you follow the cobalt market, the price has been a real tailwind there as well. We've seen pricing more than double in the last 12 months. So we're benefiting from volume expansion and pricing tailwinds, which is really, really important. That's been a really strong asset for us. Secondly, that I'd point to here is Mimbula, number 3 on the list. That is a project which we acquired last year. It's a stream over a producing copper mine in Zambia. That project is expanding from 14,000 tons in 2024 up to 56,000 tons per annum. So it gives us nice near-term growth. So that and Voisey's Bay, those production assets are still growing, and that's low-risk growth you can see there. And that's complemented by, in green, the development projects. I won't go again through the list, but 1 or 2 to bear in mind that might have some material developments this year. We're in Canada, so you may well be familiar with Capstone Copper, and if you are, you'll have followed their Santo Domingo project. We have a royalty over that. That project, as Capstone said, they're looking to FID from the second half of this year. So all eyes are open for the second half of this year. And at current copper prices, that royalty is probably worth around $40 to $50 million a year to Ecora. On a business that's doing 55 to 65 at the moment, that's clearly a material step forward for us. The other one to watch out for probably is West Musgrave. Without getting into the detail, it's a copper-nickel project in Australia. It was part suspended 25-30% through construction a couple of years ago, and there's potential for a change of control there, which could see a motivated buyer come in and drive that project forward. And that, again, could be a really significant catalyst for us. And then looking into the longer dated stuff, as I say, Patterson Corridor East is one we're super excited about, and we're very closely monitoring the work NextGen are doing there, where the drilling results just keep being super exceptional. And that really is looking like a world-class uranium discovery, and we wait for more detail on that as the year goes on. Bringing that together, what you can see here is how that will evolve into income and translate into income, or portfolio contribution as we call it, for Ecora over the coming years. I mentioned briefly at the start that this was very much a coal-orientated business 10 years ago. And what you can see in the grey dotted line on the left of that chart is in 2020, where probably 80-90% of our income, you can see, was coming from coal. And the blue and the yellow is our specialty metals, which was less than $10 million. 2025 is a real landmark year for Ecora. The blue and the yellow bars there are exceeding coal for the first time. So our critical minerals revenue exceeds the coal income for the first time in 2025. Then we see that near-term growth out to 26 and into 30. The hash bar is the development projects I talked about coming into production, which will really drive the growth of this business. So if you look through the grey dotted lines, which are the coal, actually look at the growth in the critical minerals business. This is a really fast-growing critical minerals business, which will go from $10 million of income in 2020 to 100 in 2030. And we've been using that coal effectively as a way to fund that. Our capital structure is very clean. There's no warrants or anything like that. The shareholder base, South32, the mining company, is our largest shareholder at just over 17%. They took equity as part of the transaction when we bought a couple of those development royalties. And then some UK institutions. Aberforth is a Scottish institution. Schroders are more well-known internationally. And then some other names there where we've seen good, strong buying in recent months, driving some exceptional share price performance. We're up over 100% in the last 6 months. We're very well covered for a company of our size, and we're hoping to expand that analyst coverage out. And the directors have been buying quite extensively. They're not a founding management team. This business has been around for a long time in some different guises. But Kevin and Mark have been with the business for over 10 years now, and they've built most of those positions by buying shares in the open market. With that, I'll just surmise. So Ecora, we think they're playing a differentiated approach to the royalty model. It's a proven model, but we're playing into that critical mineral space. Copper is very much at the core of our portfolio. The exposure we give there is to some of these mega trends like electrification, digital infrastructure, AI, data centers. Those are all driving the demand for these commodities. We've got a very clear and strong organic cash flow growth profile, and all those assets that are driving that growth, we've paid for all of those royalties. So there's no further capital commitments, no further money going out of this business. We can just wait for those royalties to come on into production. A good diversified cash flow in production portfolio and an established track record. So we think that, say, 2025 is an inflection point, and we're really excited about what the future can hold for this business as we look forward to the end of the decade. Thank you for your attention. If you've got any questions, please swing by booth 401.